Good morning, everyone, and welcome to Your Money Matters. We are recording this on a Friday, and we just got a very surprising jobs report in. So Clint Lee and Ted Bauman are going to take a unique look at that and provide some warnings that you might not be thinking about, even though it is good news. But before we get into that, Ted, I wanted to pivot kind of quickly. You've been taking some heat in the comment section, and I wanted to give you a minute to address that.
Yeah, I just noticed from my Friday video, which of course the timing couldn't be worse. Basically I was pointing out in my video that the issue really with the economy as a whole is that it's propped up, or at least the stock market is propped up by, the Fed stimulus, and that therefore one needs to be extremely cautious. And, it's not really a real, price levels are not realistic. But apparently some people interpreted that to mean that you should just stay out of the market. Well, that's not at all what I've ever said. I said what you got to do is look for the undervalued sectors that have the potential growth behind them. And in fact, if people had bought into the sectors that we recommended, like housing, for example, they would have made a lot of money, because that's precisely what we're doing. We're saying, you just need to make sure that you pick the right ones. If you put all your money into Amazon and Google and all of those, and followed them up, you see them pulling back recently. And so I think the problem is that maybe our videos are too long and we don't get that people don't watch them to the end, and so they miss.
Listen to the end. You listen to the end.
But we'll take that as a sign that we should try to make our videos shorter and more to the point. So today let's do that. Let's get right down to business. And so let's start with it.
Let's start with it.
Right. So.
We looked at that jobs report, and 2.5 million jobs were added as opposed to the 8 million or so that we thought would be shed, which surprised the market. As of right now, I think we're up 3.5, almost 4% on the Dow. So what do you have to say about that, Ted? Because, again, everybody's very surprised by this, and it's been very good news for the market.
Well, it kind of makes me wonder why people are surprised by it in a sense, because when you disaggregate the job recovery that we've seen, and we have a chart we want to show you just now, it's clear that that shouldn't have been unexpected. Let's show the chart. So the chart basically shows that the big recovery, fully half of the jobs were in leisure and hospitality. So this is basically servers and bartenders and baristas and people coming back to work as restaurants and local places have reopened. So that shouldn't have surprised anybody. We know that those people are coming back to work. The big question is, of course, whether the customers are coming back to work. That's a different question. So at one level, I don't think this should have been a surprise. I think it was a surprise because particularly when you're doing macroeconomic stuff, you tend to extrapolate from past performance, and the assumption was that that's what was going to happen. It doesn't change my basic view, which is that going forward, everything matters on how much money is being spent in the economy, where it's being spent, how that shows up in the earnings of businesses, and whether or not that is going to sustain the level of price action we've seen in the stock market. Just to take an example, even if all these servers and people go back to their jobs, are they serving as many customers? If they're not, that means that the restaurants are not going to be ordering as much stuff from big companies like Cisco. Big companies like Cisco are going to see declining revenue. That's going to mean that if their prices, their stock price is too high, eventually it's going to have to come down, because people don't buy stocks just because of a number. They buy because the companies are going to earn money. So fundamentally, I think, yes, it's good news in the short term, but to me, it doesn't change the overall picture.
And these are people whose income depends on how many customers they have too, so they have less money to spend.
Well, yes,
that as well.
Yes, I mean, I think that with the government stimulus and all that sort of stuff working its way through the economy for a while, I think people will spend money. The question is whether they'll go out to do it. I mean, AMC Theaters, for example, has basically just said that they don't even know if they're a going concern anymore, whether they actually have a business that they can sustain. So yes, it's great that people are going back into some restaurants if they're doing it safely, of course. But this doesn't mean that the economy is out of the woods. And on that score, though, I wanted to ask Clint to show us some sectors that are rebounding, but that have the greatest potential for gains as the economy slowly recovers. And again, remember, this is not a question of saying it's either yes or no for the stock market. It's where is the value? Where are the gains going to come? So don't stay out of the stock market. Listen to Clint. See which sectors are going to give us the gains. Clint?
Yeah, well, one thing I want to start with is the knee-jerk reaction in the markets to the news this morning of, as you were pointing out, Angela, the 2.5 million jobs that were created. Right as the announcement came out, I was watching both S&P 500 index futures and NASDAQ futures. S&P futures went higher immediately, but interestingly, NASDAQ futures initially sold off. Now, the NASDAQ's recovered, but initially, right when that number came out, you saw futures move lower. Of course, the NASDAQ is a very tech-heavy index. But as an extension of that, one of the trends we're seeing today is a big reversal in some of these stay-at-home stocks. And that's the first chart I want to share with you here. Now, this just shows what the S&P's done versus some of the stay-at-home stocks like Zoom, Amazon, Netflix, Peloton, just over the last day. So don't get me wrong. These stocks have seen phenomenal gains throughout this pandemic. But with the news that, what you're sharing earlier, Ted, with the leisure and hospitality jobs coming back, just goes to show sort of the progress that's being made toward the reopening and the impact that that's had, at least near term, on some of these stay-at-home stocks that have been so popular with investors. But to your point, we are up 3% today on Friday as we're recording this, so that money is going somewhere. And I have several charts I want to show to illustrate the sectors that are seeing these flows, and a lot of them are value-oriented sectors. So I want to start with IYR. It's a real estate ETF. I'll show you a chart here. Now, with all these charts I want to show you, one thing I want to point out, a couple things I want to point out. One is that these all go back a year. So you can see the magnitude of the decline that we had. But then we had this rebound off the lows. But then for a lot of these sectors, they have traded sideways. They moved sideways for about a month. But just over the last couple weeks have really started to put in this big move higher. We've seen this big turnaround in value stocks leading away, and that's another trend we're seeing here this morning. You can see that with IYR right here. The next chart I'll go to is XLE. That is an energy sector ETF. You can see the rebound. Once again, it's staging here. Now, energy got a lot of attention because in the depth of the crisis, oil prices actually went negative. But once again, as we're seeing the progress with some of these reopenings and just how beaten down the sector was, we're seeing this nice rebound. The next chart I'll show is for industrials. This is XLI. Industrials has, within the value space, been one of the leaders, but they're continuing to recoup the losses that they had earlier this year. Financials is another sector that we'll show right here. You have a big concern over loan losses with the unemployment figures we saw before this month. But if things don't look to be as bad, we're seeing the rebound financials. And the last two here, one is transports. This is XTN. We've seen a lot of headlines recently around what's going on in the airline space. There's a lot of airlines in this transport ETF along with freight companies. If the economy's on the mend, that would benefit this ETF. And the last one I want to show is SMH. This is for semiconductors. Now SMH is breaking out to new all-time highs. Here as we're recording this, there's still a lot of value in the sector, but there's also some political pressures that we've talked about recently building as well that's been benefiting those stocks.
I have a question for you regarding these fantastic rallies that we are seeing. Does this mean that we're headed for a genuine rebound, or is this all due to Fed intervention?
Well, I don't think it's either or. I think, first of all, I've argued consistently, really over a long period of time, that the liquidity actions of the Fed have had a dramatic impact on the stock market, and that's where inflation is. Everybody looks for inflation in the real economy, but that's not where the money's going. It's going into bank reserves, which are then being used to backstop speculative investment in the stock market, whether it's by individuals with margin accounts, whatever you want to do. That money basically is available to be lent, and that's where it's getting lent to buy assets. That's inflation. That's what I call it. And let's just show a chart that shows you what the increase in the money or the assets of the Federal Reserve has been. You can see from this chart that from March, just an absolute skyrocketing, nearly doubling of the assets of the Fed. So what that tells me is, yes, the stock market is overvalued. And I think the fundamental question is, can it catch up to those valuations that have been provided by Fed liquidity on the basis of the real economy's activity? And I still don't think anybody can say that for certain. One job report does not a stock market make, folks, nor an economy. Basically, I think the real question is, do we have a path to the return to the level of earnings that would be required to sustain the price earnings ratios that we have? So let me show you a chart on that, one I showed on Friday. This chart shows the relationship between the PE ratio for the S&P and the level of the S&P. And as you can see, it has completely overshot the value of the S&P itself, which basically means that even at this depressed valuation, the stock market is pricey relative to even its recent past. The next chart I want to show you is one that shows a couple of estimates for what the current PE ratio is if you look at a couple of different estimates of what earnings will be in 2 years' time. At the worst estimate, we could be at 26 times earnings. That would be historically unprecedented, almost the highest we've ever had it. The best estimate really puts us at about 20. So it all depends on what happens in the future. And here I want to show one final chart, which shows the projected trend in GDP. Remember, having 1.2 million waiters and baristas and folks coming back to work is not going to rescue the entire economy. And here's why. This chart shows the dramatic drop that we expect to see in the second quarter. But the critical thing is that we never get back to our previous GDP levels, even over the next 3 to 4 years. GDP is what drives corporate earnings. You can't have a stock market that continues to rise indefinitely if corporate earnings are just not catching up. So I would be thrilled if to be wrong about this, but I still maintain that until we see what's actually going on in the demand for the things that make the economy really go, really tick, then yes, I maintain that this still is a bubble economy fed by the Fed, if you like. So yeah, I'm not going to change my call on this one, but again, it doesn't mean that there isn't value. Clint just showed you where there's value. The thing is, you've got to look for the tops in those sectors, because eventually the smart money is going to say, hey, we've squeezed everything we can out of this lemon. We're going to sell again. So it still need to pay attention to that stuff, folks.
All right. So then what it always comes down to, what should we be looking for?
Well, I think the key thing is, and you know, I know people say that we're here punting a newsletter, but that's what we're here for. We're basically trying to give people an opportunity to share in what we do. We look for the big winners, and we've spotted them. We've got them. We've had a couple of stocks that have hit, like, you know, 30, 40, 50% just in a couple of weeks or months since the crisis started. And we do that by looking at stocks that are undervalued in real economy terms. In other words, stocks that should be worth more than they are, but aren't for whatever reason. And it's often because they're tarred with the brush of a bigger sector. Real estate is my favorite example. Everybody thinks that a retail real estate investment trust, or REITs, you got to stay away from them because nobody's going to the stores. But there are different kinds of stores out there, right? And the thing is, what we do is we look for the stocks that are getting punished by association, but are still fundamentally strong, and they've been beaten down, and we buy those. So that's what we do. But we don't stay out of the stock market by any means. We've actually made quite a lot of money in the stock market in our portfolios in the last month or so by doing exactly what we're explaining here. Be skeptical about the big picture, focus on the opportunities in the micro level. And I'm afraid that a lot of investors don't do that. They just, you know, they just go in the headlines. So that's my advice, folks. And if it means subscribing to our Bauman letter, please do. We'd love to have you. It's not that expensive. Yeah,
and we have, like you said, seen some great gains. So I really hope everybody stay tuned. I hope everybody heard your message today. Do not stay out of stocks. Be smart about the stocks that you buy, and we can certainly help people there. So for more information there, you can see the link below. There's a link above. And that's all we've got for you today. Thank you, Ted. Thank you, Clint.
Thank you very much. And I know you're seeing us on Monday, but everybody have a great weekend. I'm looking forward to taking some time off. I really need it.
Thanks a lot.
All right.
Thank you.
Take care. Bye.